Sergio Ermotti, welcome to Bloomberg. Good to see you again.
Thank you.
When you watched the markets convulse last week, did you reflect and think this could be the torch paper of 2011, 2012? What went through your mind?
No, I think that, yes, I felt that we were starting to go into very dangerous zone in terms of, the spreads on the Italian government bonds going to level not seen for a long time, and the contagion could have been there. But on the other end, I was quite optimistic that things could be brought back in control. Maybe it's just because, if I go back into the last few years, we have been seeing a lot of those kind of tensions coming up, and then after a while, a solution would be found. So, but of course, I'm still concerned about what's going on in Europe in respect of, the stability. It's not just an Italian matter. I think that if you look at Spain, if you look in general, the rest of Europe, it's set up still room for improvements.
Is Europe going to need much more reform? Is that what we should take away from the potential Italian challenge to the rest of Europe?
Absolutely. I do think that Europe in its current form has a hard time to become credible and viable in terms of financial strength without fiscal consolidation, without fiscal union. I would say it's very difficult. I think it's going to be very difficult to tackle the geopolitics and geoeconomic issues that we are facing nowadays, with protectionism coming up and also tensions around the world, without a one voice in terms of foreign policy. And last but not least, I would also say that the entire issues of defense has to be tackled in a completely different way.
Those are pretty major issues. If we try to distill it down, George Soros said that there was an existential threat to Europe. That was his phrase. James Gorman at Morgan Stanley said, look, that's utterly ridiculous. How would you describe the threat level from last week to Europe?
Well, I mean, I'm not going to go into arguments on the language used by the two gentlemen, but I would say that, maybe the truth is a little bit in the middle. I think that a threat, you have to measure the intensity of the threat, and I would also describe the situation as being serious enough to, be addressed and tackled. I mean, I don't think that the current status of the situation, just relying on the fact that we had a recovery from an economic standpoint of view the last 18 months or so, is not enough to fence off those reservations. And in my point of view, reform needs to come in Europe, and they need to be driven with a sense of urgency.
For the markets, volatility spiked. Was this a timely reminder that we are going into a higher period of volatility?
Yeah, volatility spiked on bonds, but if you go back into the levels of the VIX and in general, you look at FX movements, yes, we saw some movement, but it's not a lot of volatility compared to the standards we are used. So I would say overall, investors are very cautious still. They are out there observing the situation. They are not panicking, but they are starting to get concerned.
Was there any reduction in risk by yourself and Andrew Orchel? Did you take any risk off the table?
I think that we have been very focused on managing our risks for a while now, and this is clearly not an environment in which you put on more risks.
What about Italy? Did you have any material exposure to Italy that we should be cognizant of?
No. I mean, it's our exposures in terms of countries is well within our risk appetite, and I'm comfortable that in any case there is no substantial short-term risks posed to Europe or any countries in Europe.
One thing that I focused on last week was that the doom loop between sovereign risk and banks, it was alive and well. It hasn't gone away.
Well, look, at the end of the day, banks are a transmission, mechanism for the economies, and if the underlying economy, if the underlying political landscape in unstable, banks are suffering. So it's quite normal. Having said that, I do think that banks in Europe, in general, are in a much better shape than they were 10 years ago. And I'm pretty convinced that the system would be able to absorb any shock related to any bank. The problem is going to be, what are the rest of the shocks? I mean, outside the banking sector. And this is not, I don't think it's any longer an issue of banking system. I think it's much more about public finances, the underlying economy, and the structures that needs to be implemented to create a better environment.
Well, you say that, but then I look at Deutsche Bank, which has a market cap of 20 billion euros, credit default swaps that are rising, a credit downgrade. I'm just curious to know, when you took over this bank back in 2012, is Deutsche Bank at a worse position than when you arrived in the full-time seat here?
I mean, it's difficult to make a comparison. I think that, for sure, we back then, what we did is we focused on our strengths and we reshaped our balance sheet. And I think that Deutsche is going through a similar exercise, and I think it's the right thing to do at this stage. So it's very difficult to make a parallel, also because we have quite different business models.
One of the things that the market is looking at is counterparty risk. I want to understand from you, as the CEO of a major bank, how the market should be focusing on Deutsche Bank. Is it about counterparty risk? Because if counterparty risk is taken away, that is the beginning of crises.
I don't think there is any counterparty risk per se, and I think that it's very difficult for me to make judgments about another bank at this stage, but I don't believe that there is any counterparty risk in the system at this stage that is meaningful.
As I say, you have a market cap of 3 times the size of Deutsche Bank. At some juncture, you must, as a CEO, run a slide rule across other banks and institutions. We've talked about consolidation before. Is there a point in time where you say, this can offer value, Deutsche Bank?
Well, of course, I'm not going to comment on consolidation, that other than saying that in general, not necessarily for UBS, consolidation may be part of the solution to reshape the banking industry in Europe. There is overcapacity, so consolidation may be one part of the equation, but
do you think the regulators need to be more open to cross-border mergers and acquisition?
I think in general, regulators looks like they are already moving in this direction. They do understand that the issue is not too big to fail per se, but is in some cases maybe too small to survive, as I mentioned a few years ago, and this is really coming up. But the truth of the matter is that consolidation that is just done in terms of creating size without focus and added value to clients and shareholders may create even more problems than solutions. So I think that what we need to see in the industry is focused consolidation, where you get scale and diversification.
Can you see a European banking landscape where global regulator or European regulators would allow a US bank to come in, a Chinese Tencent to come in and pick up? Listen, it's something that people are talking about. I mean, that's something we've got to consider.
It's very difficult to judge that, but I do, if I think that most likely European regulators would be open to any credible solution that brings an industrial logic and also financial strength and the appropriate regulatory oversight. So it's very difficult nowadays to rule out that any governments would be opposed to something that adds value. Having said that, nowadays I understand the legitimacy of your questions, because if you look at protectionism and every country looking at their own interest, you may also see some things in the opposite direction.
You've mentioned trade and protectionism twice. Is that one of the biggest risks when you're talking to the clients? We're in the foothills of disagreement of G7. You've mentioned it twice. Why is trade so important from your prism, through the prism of the UBS client?
Well, because this is eventually one of the factors, together with geopolitical risk, that can basically change the pace, the positive pace that we are seeing right now in the economy. I mean, we still have although the last quarter in the US was not what we expected, but still on a global basis we are still growing closer to the 4% than the 3.5%. So pretty strong growth globally. And what I can see coming in terms of potential escalation of protectionism is a slowdown in the overall economy, and therefore one has to be concerned about that.
And to what extent do you think that's going to dictate central bank policy as well? We've got the Fed hoping to move, guiding us towards more movements. The ECB's got a whole other set of issues to deal with. What does it do to policy in terms of rates around the world?
Well, if I look at probably the latest events in the last 2 or 3 weeks or so, if you look at Bank of England, if you look at the ECB, most likely they're going to be a little bit more cautious potentially about hiking. Bank of England has clearly signaled that lately, and I think probably the ECB is going to be a little bit on a wait and see until they see Europe stabilizing. The US, it's all depending on inflation and what's going to happen going forward. So I think that there is a chance that the Fed may go on its own and still deliver the expected hikes between now and year end.
Have you seen any caution from the client side, any hedging, any movement towards cash, any sort of angst in this quarter from the client side?
Well, look, we are recommending clients to still be in the market because the underlying profitabilities, the growth that we see are still supportive of equities in general terms, but we are also very careful in signaling that the cyclicality may come in, the geopolitical risks and geoeconomic risks that I mentioned before may be there, therefore hedging. Thinking about diversification and hedging is an absolute must in this environment, and one has to pay attention not to be too complacent.
And finally, to close, how much attention do you pay to the yield curve, and will it invert?
Well, we pay a lot of attention because that's clearly the last things we need nowadays in banking is, in addition to negative rates in Europe and Switzerland, is to see an inversion of the yield curve in the US. For the time being, it's okay, but we are watching this situation.
40 basis points is very tight.
It's very tight. We are getting into a very dangerous zone.
Sergio Ermotti, always good to talk to you. Thank you very much for joining me on Bloomberg.
Pleasure.